Oh, my portfolio. Gold down 21%, silver down 41% in 1 week. One single week. I was sitting at my desk on Friday morning, January 31st, 2026, holding my takeaway coffee like I do every morning, and I watched my screen turn blood red. My hands started shaking, not because I had too much caffeine, because I thought I had just lost everything. You know that feeling? When your stomach drops and you start doing mental math on how much you just lost? When you start thinking about all the hours you worked to save that money? Yeah, that was me. That was probably you too if you're watching this. And for a moment, just a moment, I thought about selling, getting out, cutting my losses before it got worse. But then I did something different. Instead of panic selling, I started digging. I opened Google. I searched for answers. And what I found changed everything. Not just about gold and silver, about the entire global financial system. Because buried in US Treasury filings, in COMEX inventory reports, in Chinese central bank data, I found a trail. A $634 billion trail that leads from Washington, D.C. to Beijing. And once you see this trail, once you connect all 7 pieces of what China is doing right now, you can't unsee it. You can't unhear it. And you'll understand why, despite watching 41% of my silver value evaporate in 2 days, I'm not selling. Not today, not tomorrow, maybe not ever. So stick with me in this video, because I'm going to show you something that mainstream financial media won't tell you. I'm going to show you the data, the numbers, the timeline, and by the end, you're going to make your own decision about whether this crash was the end of the bull market or just intermission. Let's start with a number. $634 billion. That's how much money China has pulled out of US Treasury bonds since November 2013. Back then, China held $1,670 million in US government debt. They were America's #1 creditor, the biggest buyer of American debt on planet Earth. Fast forward to today, and that number is $682.6 billion, the lowest it's been since 2008. Think about that for a second. $634 billion removed from the American financial system. That's not pocket change. That's bigger than the entire GDP of Sweden. That's bigger than Switzerland's economy. China took an entire European country's worth of money and pulled it out. And here's what should terrify you, or excite you, depending on how you look at it. The pace is accelerating. Now, here's the question that nobody on CNBC is asking. The question that kept me up at night when I found this data. Where did $634 billion go? Because money doesn't just disappear. It doesn't evaporate into thin air. It moves. So where did it move? I'll tell you exactly where it went. It went into gold. Your metal. My metal. The same shiny yellow metal sitting in your safe or in your brokerage account. The People's Bank of China has been buying gold for 14 consecutive months. Not 13 months, not 12 months, 14 straight months. They did not skip a single month. Not when gold was at $3,000, not at $4,000, not at $5,000. Not even when gold hit its all-time high of $5,680 per ounce in January. They bought every single month at every single price level without blinking, without hesitation, without second-guessing. Think about what that means psychologically. You and I, we hesitate when gold drops 2%. We panic when it drops 10%. We have sleepless nights wondering if we bought at the top. China? They bought through a 69% annual rally like it was nothing. That's not trading. That's not speculation. That is a national directive. But here's the number that should hit you like a freight train. China's gold reserves, even after 14 months of aggressive buying, represent only 8.5% of their total foreign exchange reserves. Let me give you some context. The United States holds 66% of its reserves in gold. Germany, 68%. Russia is at 30%. And China, 8.5%. Do you see what that means? If they want to reach even Russia's 30%, not Germany's 68, just Russia's 30, they need somewhere between 5,000 and 7,000 more tons. Think of it like a marathon. China has run 1 mile. The finish line is 26 miles away. And every single ounce they buy from here pushes the price of every ounce in your safe a little bit higher. They have 25 miles left to run, and they're not slowing down. So when someone tells you, when your brother-in-law or your neighbor or some talking head on TV tells you that the gold bull market ended last Friday, ask them one simple question. Which central bank stopped buying? Go ahead, name one. I'll wait. You can't, because not a single one stopped. Now, gold is only half of this story. What's happening in silver right now should genuinely frighten anyone who doesn't own physical metal. The silver market has been in a supply deficit for 5 consecutive years. The cumulative shortfall? 820 million ounces. That's roughly an entire year of global mine production. Gone. Embedded in solar panels, soldered into circuit boards, inside electric vehicles. That silver is consumed, used up. It doesn't come back. And here's the kicker. Mine production is flat. You can't just decide to open a silver mine when prices go up. It takes 10 to 15 years. But the demand curve from AI and solar is vertical. Those two lines are racing in opposite directions. But the inventory data is where it gets truly alarming. COMEX inventories have dropped 70% since 2020. And right now, today, there are 356 paper claims for every single physical ounce of registered silver. 356 to 1. Think of it like a game of musical chairs. 356 players, 1 chair. When the music stops, what happens? If you don't believe me, do this one thing. Pause this video. Walk into your local coin shop or bullion dealer. Ask them to sell you 100 ounces of silver at the spot price you see on your screen. They won't just say no, they will laugh at you. That laughter? That is the sound of the decoupling. The paper price on your screen has crashed, but the price to actually get your hands on the metal has not. Now here's where I need you to zoom way out. Because gold and silver, they're just the ammunition. The weapon China is building with that ammunition? That's something else entirely. Remember I said there are 7 pieces to China's strategy? Let me walk you through the rest, because this is where the geopolitical chess game becomes clear. Piece 3. CIPS. Most people have never heard this word. Think of the SWIFT payment system like the internet cables of the global economy. Right now, all those cables run through Washington. If America doesn't like you, they pull the plug. Russia lost $300 billion overnight because the US pulled the plug. China saw that and decided they weren't going to let that happen to them. So they built CIPS. It's their own separate internet, a financial superhighway connecting 4,900 banks across 124 countries that America cannot switch off. Piece 4. The digital Yuan and mBridge. China built a cross-border settlement platform, and here's the game changer. Saudi Arabia joined. Saudi Arabia, the country that created the petrodollar system 50 years ago, the bedrock of dollar dominance. They are now sitting at China's table, testing payments in digital yuan. What do you think happens when every other oil-producing nation sees the Saudis making that move? They start asking for a seat at the table too. Piece 5, 6, and 7 are about tightening the noose. 1/3 of Chinese trade is now settled in yuan. They are converting the sovereign debt of countries like Kenya from dollars to yuan. They have officially written currency strength into their national 5-year plan. This isn't a secret, it's state policy. Now, before I go any further, I owe you honesty. The dollar is not dying tomorrow. It's still 56% of global reserves. But the monopoly is ending. It's like two restaurants in a town that used to only have one. The old restaurant is bigger and more established. But the new restaurant is open now. And for the farmers who grow the food that both restaurants need, that's you, the gold and silver holder. Business has never been better. So where does this go from here? What are the biggest banks on Wall Street doing after the crash? JP Morgan raised their gold price target to $6,300. Citi raised their silver target to $150. They did this after the crash. Why? Because they know the central banks haven't stopped buying. They know the deficits haven't closed. Remember the 1970s. Gold crashed 50% before it went up 800%. Silver did the exact same thing. Does last Friday feel familiar now? Does a 41% crash after a massive rally sound like something you've heard before? What happened on January 31st wasn't the finale. It was intermission. A mid-cycle shakeout designed to scare the tourists out of the market. So here's my final question for you. While CNBC tells you to sell, China is buying for 14 months straight. While your neighbor says the bull market is over, central banks are draining the vaults. While JP Morgan crashes the paper price with margin calls, they're closing their short positions at the exact bottom. Who are you going to listen to? The talking heads or the smart money? Are you going to be the person who sells in panic or the one who buys alongside the central banks? Let me know your plan in the comments below. I'm listening to the data. I'm watching what central banks do, not what financial media says. And right now, they are buying like there's no tomorrow. Maybe they know something we're finally starting to see. If this helped you see the full picture, drop a like and subscribe. Because the story isn't over. Not by a long shot. I'll see you in the next one. And remember, oh, my portfolio.